Welcome, investors. Today's May 6th, 2016. I'm Grant.
I'm Adam.
And Gary's behind the camera, and we are Dynamic Wealth Management. Welcome to our video update today.
So the temperature's been picking up here in Arizona, getting a little warmer, kind of stormy today. Kind of like the markets. Been a bit stormy and went down about 2 weeks now in a row, although some sectors are still moving up. And we got some more clarity now in the elections. We now know that the presumptive candidate will be Donald Trump, the Donald, for the Republicans, as his other competitors have dropped out. We'll see how that affects the markets going forward. Kind of a crazy day today with jobs report.
Yeah, we'll jump into the charts and show you what's going on out there.
Okay, so for our May 6, 2016 update, let's have a look at upcoming events. We have coming up one more investments for breakfast. That'll be this coming Tuesday, 9 a.m. in our office. We invite those who have not met with us before to come in. It's an opportunity to talk openly with us, get to know us. It's open to both our current investment clients as well as those who are considering becoming clients. Chance to talk, ask questions, and hear our views on the market in a less formal setting. As far as investment seminars, we're going to take a break for the summer now, as many of you are as well. But we will continue these videos, so we encourage you to keep watching, checking your inbox, and learning what we're seeing in the markets and what we're doing in your portfolio. So for the core ETF model, our risk indicators remains in the bullish territory. It was barely out of neutral. The market was looking weak, like it wanted to roll over, but our indicators pointing towards bullish, and so we have continued to move into the bullish position. We're now fully allocated in those positions, though we did move into more defensive areas, which included the Dow Jones Industrial Average and consumer staples, which are showing relative strength versus the overall market. So we'll remain in the bullish risk on until the market tells us otherwise. It has been down the last 2 weeks, but we're still in bullish territory. We don't want to get shaken out if it's going to continue to move up. And move up it may. We'll talk about what happened today as a reason why you may see it continue to move up. So now looking at some key events. Last week, Japan dropped a bomb on us. They basically said, we are not going to continue to stimulate. We are done. It's not working. We're not happy with it. It's a failed experiment. And so while stimulating rates and stimulating the economy through quantitative easing seemed to work in our country, at least for the market it did, Japan has determined that it's no longer worth the effort. It's a failed attempt. It's not working, and so they have abandoned that. You might imagine that would have some pretty crazy repercussions for Japan, which it did. Since they're not going to keep stimulating, which weakens their currency, that strengthened their currency. So the yen jumped up substantially on that news. However, when the yen jumped up, we saw a corresponding drop in the Japanese market. So big drop in the Japanese market, and now since that there was the announcement right there, you can see the big drop. And just for that time frame right there, we're down 7% in the Japanese market. Looking at the Chinese stock market, likewise, they reported some soft numbers, and there's some concerns there, and so China now has come down, although you'll notice it is at a support level. We'll see where it goes from here. In the U.S., market has been coming down the last couple of weeks. Today, we got a very bad jobs report. A bad jobs report, you would think, would weaken the market, which initially it did. The market was down in pre-market, in the futures markets. Market opened up, was down slightly, turned around, and ended up running up and closing up at better than 1/3% for the day. Go figure. Bad numbers. I guess they're thinking less chance for stimulus. If we look now at the likelihood of a rate increase, a rate hike now for June, it's a 9% probability they're going to raise rates in June. The chance they're going to raise rates at all through the rest of the year, less than a 50% chance. So we keep jumping back and forth on this interest rate news, and it does have an impact on the market. Ironically, this means rates would be lower here. Lower rates in the U.S. Would mean a weaker dollar, and yet we just had the strongest week in the dollar in 3 months. Go figure. So maybe they're looking forward to the GDP predictions. We had not a very good GDP in December. We were only at 1.4%. In the first quarter of this year, it was 0.5%, which is very anemic. But now look at this. We got a forecast for 1.7% for the second quarter. Maybe that's got people excited and willing to put some money into the markets. So market, though it has gone down for the last couple weeks, maybe it's finding a little support area in here, and we'll see. We'll see how things go. The Donald, well, we know he is now the presumptive candidate. We'll see if the market likes that or not. It would seem the market would prefer to have Hillary Clinton as the president. Maybe they feel they can manipulate her more than they can manipulate the Donald. And with that, we're going to move on to Grant's opportunity to talk to you about what's going on in the markets and the charts.
All right. Well, Adam did a great job walking through the economy and showing you what's happening. Let's show you what's happening in the stock market. First, we want to go over the dollar here. So you'll notice that the dollar has been in a downward trend for quite some time now. This is a weekly chart, so every one of these candles represents a week in time. But we had a very strong week this week, which is interesting, right? Because as Adam pointed out, the yen has been strengthening, which you would expect that to really hurt the dollar. And that's kind of what you saw on last week here. But this week, we saw a pop on the dollar, maybe just because we're at resistance here and we have this support line. Sorry, we have support here, and the dollar found a little bit of strength to move off of. Now, you'll notice that as the dollar has been trending down, oil has been trending up, and we have seen very close correlations between the price per barrel of oil and the stock market. In general, they move down together and they move up together. So just recently, though, oil has been going up while the stock market's been coming down for the last couple of weeks. But this week, you'll notice, is a down week in oil because we had an up week in the dollar. Okay, S&P 500. So from this top here, this has been about 2 weeks of downward movement in the S&P 500. You'll notice now we are coming up to a support level, a couple support levels. The stock market stopped going down here, and we're sitting on top of the 50-day moving average. So it would make sense to see a little bit of a bounce here. Now, will it be a sustained up movement? We're not sure. Will it just create another shoulder over here? As you know, technical analysis, oftentimes you see a head and shoulders pattern, and there's a shoulder, a head, and if it forms another shoulder here, that is a bearish bad sign that usually you'll see some drop after that. So we'll be watching that carefully to see. But we are in the green zone, and so as Adam pointed out, we did get all the way into our bullish positions here. Meaning that we've been taking those positions strategically, and we saw here that now that we're at support and near the 50-day, we have an opportunity maybe to get some short-term growth. Now here's a look across all of the sectors here. So you'll notice U.S. stocks, we have been kind of a lagger in comparison to everything else that we see here. So real estate have been leading, up 7%. High yield bonds up 4.5%. Commodities, the big winner has been gold year to date, up 20%. And even treasuries, short-term treasuries up 5%, long-term treasuries up 9.5%. So in comparison to everything going on out there, U.S. stocks has actually been struggling. So that's one of the reasons why, if you look back and you look at performance for the year, it's not fantastic across any of the U.S. stocks, really. You get all the major indices and average amount, and that's how you get this 1% here. You'll notice that a lot of these things, commodities and gold, a big reason why you see these popping so much is that correlation to the dollar. As the dollar comes down, you see those jump up. So we'll real quickly show you where we are and what our allocations are. So here's our risk indicator again. So you see we're above the yellow line, and as long as we're above the yellow line, we are in a green bullish mode. Now we've been coming down for the last 3 weeks in a row, coming closer to this yellow line. But as you see, oftentimes it will drop just to stop above the yellow line, and then move back up again. So kind of what we're hoping for this time, that the pullback will stop soon and we'll stay in the green zone and get some growth out of this. So what do our allocations look like for our clients here in the core ETF model? Well, we're in these green allocations. So if you are a growth client, you're 100% in the market in equities at this point. If you're moderate, you're at 80% in, 20% defensive. Conservative, you're 60% in equities and still 40% defensive here. So we feel good about our current allocations. Of course, if the market does fall hard from here, we will not hesitate to get back into the yellow zone and protect our clients as they do mandate. So with that being said, thank you so much for watching our video, and we'll continue to put out a video every 1 to 2 weeks here. Thanks for watching.